interest rates and balance sheet size affect the price of money. And if you look in most markets, if we ask, are price controls good? Most of us would say no. Price controls are not historically effective. They're not theoretically effective. Markets should set prices. But in this kind of current era, we have price controls for the price of money, or specifically the price of credit. And so rather than letting the market kind of determine what is an appropriate price of credit, it's highly influenced by the central bank. So they set short-term interest rates. Sometimes they even override long-term interest rates, like what Japan's doing now or what the US did back in World War II. But basically, various parts of the interest rate kind of pricing mechanism are heavily set by the centralized group, and it's literally 12 people that decide. It's 7 members of the board of governors, and then it's a revolving set of other central bank heads. And some of these are appointed. None of them are elected. And so it's almost like a council of elders deciding this is the price of money today. And then, they divine the tea leaves, and every 6 weeks, everybody tunes in to see what color smoke's going to come out of the group of 12 people sitting around the table decide. And that's one of those things that I think it's, when people look back in the future and see that this is how we manage money, this is how we manage literally the most important ledger in the world, which is the Federal Reserve. It's not only the base layer that we all use here in the United States, it's the ledger that almost every country ties into. Right. They own U.S. reserves as assets, and then also they have on average, especially developing countries, they have a lot of dollar-denominated debt. So both their liabilities and their assets to various degrees are tied into this ledger. Domestically, we're tied into this ledger. So basically, hundreds of millions of people domestically, billions of people globally, and there are 12 people that can decide, should interest rates be 2%, 3%, 5%, 7%? Yeah. Should we expand the base layer of money? Should we do QE? Or should we decrease the base layer of money?
Bitcoin's value is on a roller coaster ride, and it recently dipped below $27,000, sparking curiosity about the factors driving this turbulence. The market has been buzzing with concerns about how global events are influencing high-risk assets, including Bitcoin. Over the past day, Bitcoin's price dropped by 2%, settling around $27,150. This drop comes after a brief period of trading near $27,700. The big question now is whether it might slip further into the $26,000 range. For the 5th day in a row, Bitcoin's value has taken a hit. It struggled to stay above a crucial technical indicator last week. If it can't hold above $27,000, this could trigger a more substantial sell-off, pushing the price down to $26,000 or even $25,000. An interesting twist is that while cryptocurrencies are going through a rough patch, traditional stock indices like the Dow Jones and S&P 500 are thriving. The connection between cryptocurrencies and stocks isn't always strong, but recent shared macroeconomic factors, like shifting expectations about future interest rates, have tied them together. Geopolitical tensions worldwide are making investors nervous. Events in the Middle East with significant players in the oil market involved are creating concerns about potential oil price spikes and their impact on high-risk assets. If crude oil prices rise, it can lead to higher inflation, prompting central banks to keep interest rates high. High rates can deter investors from high-risk assets like cryptocurrencies and stocks, making safer investments like government bonds more attractive. Historically, cryptocurrency performance often acts as an early indicator of sentiment in broader markets. If Bitcoin's decline is driven by global instability, this could be a warning sign for the stock market too. Now, shifting gears, there's a tantalizing possibility on the horizon: the approval of a spot Bitcoin exchange-traded fund ETF by the U.S. Securities and Exchange Commission, SEC. Analysts are optimistic, with a 75% chance this year and 95% by the end of 2024. Big names like BlackRock and Fidelity are also jumping into the ETF game, adding to the competition in this space. Let's continue our discussion with Lyn Alden.
Central bank as the 4th branch of government here in the United States. And kind of Supreme Court, we don't elect the Supreme Court, but they are appointed. The Federal Reserve, at least a majority of the members, are appointed, but it's still in a very opaque process. The whole structure is something that people don't really understand for the most part. Yeah. And it's just so impactful. And, for I think most other markets, we wouldn't really put up with, price setting on a long-term basis, but that's what we have to do in money. And so, it's funny because they often, and this is one of the big criticisms of them from certain schools of economics, is that they're often putting out fires that they themselves started. So they lower interest rates, they make liquidity available, people then go out and they build credit, they build debt, and then things get overheated. So they start tightening the monetary condition that breaks the debt that they previously enticed to happen.
Yeah.
And so they both devalue savers, but then they also sometimes go after debtors that they themselves encourage to get in debt. And right now, I mean, one of the big narratives is that one of their metrics for trying to get inflation down is they're trying to get unemployment a little higher.
Right.
So there's literally a part of the government essentially that is doing their best to slow down wage increases and create more slack in the labor market.
Right.
A few years ago, they were rooting for the opposite, but they were debasing the money to do so. So there's multiple different stakeholders here. And at any given time, they might be in one of their camps or another camp. And we have to hope that these 12 people get it right. And I would say their track record is not. So I think the next couple of rate hikes are more in this pause type of time frame, because they've gotten to the extent where, at least the way they measure it, they have positive real yields, even though the inflation metrics are not down to 2% target yet. And so, and they know, and they've said before, and it's true, that this comes with a lag. Their effects come with a lag. And one way, like a key mechanism for why that is that just because they raise interest rates doesn't mean that everybody's debt changes overnight. It doesn't really change until things have to be refinanced, things mature, things get refinanced. And so there's still a lot of weaker companies out there. So there's commercial real estate, there's junk rated companies with shorter duration debt. There's small businesses that rely on bank loans. These are pretty short duration types of liabilities. And all of that has to be refinanced in the next coming years at these higher rates. And so some of the downward pressure we've seen from the prior tightening has not necessarily impacted markets yet. And I think that now they're getting to a point where they're going to be more in that steady range. Maybe we'll get maybe we'll get another 25 basis points. We'll see if they're either on the every other meeting schedule, or they might even start slowing down more than that to kind of see what they've already done. And I think a more interesting question to watch is what's going to happen with their balance sheet, because if we do continue to see trouble in the long end of the curve, even though they don't directly set the price of the long end of the curve, unless they choose to do yield curve control, they do influence it by buying or selling long duration bonds. And right now, with quantitative tightening, they're effectively selling long duration bonds. They're letting them mature off their balance sheet. They're not reinvesting them. And if you do start to see liquidity problems in the treasury market, similar to 2019, when they had to stop their balance sheet reduction, you could see that again. Now, they do still have the very large reverse repo liquidity facility, but that's only good for funding T-bills. And so I don't think we're quite at that 2019 period yet where they're going to run out of room to keep reducing their balance sheet. But I do think we're in kind of the second half of this phase where maybe next year is when they get to a point where they're no longer able to keep drawing down their balance sheet. And then they either have to hold it steady for a while or start gradually increasing it again.
If you enjoyed the video, don't forget to give it a thumbs up and subscribe to our channel for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.